All right, everybody. Welcome to JWB's Property of the Week. My name is Greg Cohen. Welcome, welcome. Today, I'm going to be featuring a property that is priced under $130,000. It is already rented through 2023, and it has significant upside on the rental income. I'm going to break it down for you here live. Thank you all for joining me. If you are in the group right now and you're joining me live, I'm checking my phone. So if you'd like to post any comments or questions and whatnot, I'm here to answer those, or I'll certainly do it right after the segment here. And if you'd like to be the first to find out about the property of the week, I actually reveal it every Thursday on the Not Your Average Investor show. We do that every Thursday at 12:30 Eastern. You can be the first to know about the property of the week. You just need to register in advance. We'll send you the link so you can join us on the show, and you can register at www.nyais.com for notyouraverageinvestorshow.com. It's nyais.com, and we'll see you there. So I'm real excited about this property. It has one of those really wonderful names of a street. Don't we all just love names of a street that just make you feel good inside? Well, this one is, the property is at 7171 Lucky Drive West here in Jacksonville, Florida. As I'm sharing the screen here, here we are, 7171 Lucky Drive West, Jacksonville, Florida, 32208. Purchase price of $129,000, 3 beds, 1 bath. Lease rate at $925 a month, and property taxes about $1,800. Insurance about $1,000 a year. No HOAs. You've got your monthly management fees that we calculate for you and all that good stuff. But anytime you're looking at a property that you're thinking about purchasing, what I want you to do is to focus on monthly cash flow and focus on your total return on investment. So that's where I'm going to zoom in here now. These two are the most important metrics to look at. So monthly cash flow of $135 estimated. What does that really mean? Well, what this means is on a normal month, this is going to produce about $135 a month. The big thing to pay attention to when you're looking at monthly cash flow is not, is it $175? Is it $135? Is it $100? Is it $200? Right? There's not that much of a difference between those figures right there, right? It's not going to change your life whether you have $200 a month in cash flow on one property or $100 a month in cash flow. The big thing here is you have an opportunity to buy an asset that you take smart debt out on, meaning that you're using other people's money. You're able to incur the cost of that debt, right? That principal and that interest payment that you make every single month, and it still pays for itself and then some. And the reason that's so critical is because if you take out smart debt and you apply it to an asset that pays for itself and goes up in value over the long haul, over a full market cycle, then you have an opportunity to create a lot of wealth. And the other thing is that when you buy rental properties, many people have pretty big goals when it comes to a rental property portfolio. They'd like to generate maybe $5,000 a month in income from it, or $10,000 a month in income from your rental property portfolio. Well, in order to do that, you need to have a decent number of properties in your rental property portfolio. It might be 5 or 10 or 15. And the thing about this cash flow number that's important is if it's positive or it's anything more than break even, that means it's not negative, which is a good thing. Because if you're going to accomplish that big goal of $5,000 or $10,000 a month, and you're going to have a number of rental properties in your portfolio, you don't want this to be a liability every month. You don't want to have to come out of your pocket every single month to support the property on a normal month. So it being break even, slightly positive cash flow, should translate to this being a scalable model for you to be able to build a consistent portfolio, to be able to have this other asset class in your overall financial portfolio. And that's really what I'm looking for when I'm buying cash flowing rental properties. Is it now scalable? Does it support itself? And then I hold on for a full market cycle or longer. And that's where all 5 of the profit centers really kick in. So that's really what I look at with that $135 a month on an estimated basis. Specifically, the way we get there is we take your rental income coming in, we subtract all of the expenses that happen on a normal month. And those normal monthly expenses would be your principal and interest payments, your property taxes, your property insurance costs, and your property management fees. And the net amount left over after all of those is estimated at $135 a month for this home on Lucky Drive. The next metric to look at is your total return on investment. So this is a little bit more holistic, right? Cash flow is slightly myopic. You're only looking at the net rental income, which is one of only 5 of the profit centers. Now, when we look at total return on investment, we're looking at other profit centers. Specifically, we're looking at tax savings and principal paydown. We're also looking at other costs that will be incurred on this property. I just don't know exactly when. They don't happen every single month. So some of these costs would be your maintenance costs, your vacancy costs, tenant placement fees are included here. So we need to take the additional good things like the tax savings and principal paydown. We also need to take the additional bad things that happen into account. And when you do all of that, you divide it by your initial investment, you're left with over an 8% return on investment, which is great. Right now, the Jacksonville market is varying between 8 to 10% returns for our passive income cash flow rental properties. So this is a win right here. And that's one of the reasons that I bring it to you. There's one profit center that I haven't talked a lot about here. Well, there's actually 2 profit centers that I've left out here. One of those is inflation hedging, which we don't reflect here on this evaluation, but is a real thing. The other one is home price appreciation. And many people aren't familiar with how to actually evaluate home price appreciation. If you go back to prior to 2006, as you know, the real estate markets ran up in value, people assumed that home prices went up every single year, all the time. I mean, there was a big day of reckoning when they realized that that was not exactly how it works, because no market works like that. But people didn't think about that. I started to invest in 2006, and it was nobody thought that prices went down, and it was just, I don't know, people just lost their sense of reality. Now, since then, when the Great Recession happened, home values dropped over 35% in many places in the country and in Jacksonville. Since then, people have gone the opposite end of the spectrum. And when it comes to evaluating rental properties, and they say, well, listen, I don't want to count on home price appreciation at all. And they've gone the complete opposite end of the spectrum. And neither of those 2 viewpoints is correct, actually, because what happens is real estate is cyclical. What that means is that history repeats itself in terms of home values. You just have to give it a long enough timeline. And so a real estate cycle is defined as between 10 to 20 years, because if you go back and you look at 10, 15, 20-year segments over time in your local market, just like we can in Jacksonville, what you're going to see is that average annualized home price appreciation rate in your market and in Jacksonville is largely going to match what the historically accurate home price appreciation rate is. So in Jacksonville, historically, on average, over the last 30 years, we've appreciated at a rate of 4.3% on average. And you can go back and find that information for your local market if you're investing in another place. But what you can do when you know this information is, if you're investing for a full market cycle, which is what I recommend, which is what our clients do, then you can then count on that home price appreciation on average year over year, as long as you give it a horizon of a full market cycle. If you're only investing for 1 year, 3 years, 5 years, I don't think you should be counting on home price appreciation. But if you're invested for a full market cycle, history shows us that you can depend on it, and you should be using this to evaluate which market you're investing in and what your expected returns on investment will be. So with that, we're going to go ahead and add in the home price appreciation expectation into this evaluation. And right now, prior to this, that 8.45% was assuming there was 0% appreciation, which is not real. Again, every year in Jacksonville, on average, since 1991, we've appreciated at a rate of 4.3%. Again, that's an annualized number, and that's on average. So let's put in 4.3%. What you'll see here is that jumps your total return on investment to over 24%. This is why I'm such a big advocate of smart debt. Smart debt allows you to use other people's money. And when you're investing in an asset that you can take out leverage, you can take out smart debt, and that asset goes up in value 4%, it does really big things for your return on investment, because your return on investment is calculated by what is your growth, what is your return over what was your initial investment. And when you take out smart debt, you might only put down 20% or 25% on the property. And that jumps your returns. Here's a quick example. If you, let's just say that you own you own a you bought a property, and let's just say for ease of use, it was $100,000 when you purchased it. And if that market value goes up 4% in that year, that value of that home is now $104,000. So you earned $4,000 on that gain just from appreciation, none of the other profit centers. If you paid for it in cash, you put down $100,000. So your return on that investment is 4%. $4,000 over your investment, which was $100,000. That's 4%. But let's say that you smart debt, and that same property, which cost $100,000, you only put 25% down. You put $25,000 down in this example. The value of the home still went up $4,000 though. If you take out your calculator and you do $4,000, which is your return, over $25,000, you'll see that that's actually a 16% return on your investment, which is why people need to be counting on home price appreciation in your overall return expectations and in your decisions of which market you're going to be investing in. Because the biggest impact to your long-term return on investment will not be net rental income. It will not be positive cash flow. It will be home price appreciation. Again, you just have to hold on for a full market cycle. That's how you win in rental property investing. So when you do that, you can see that your returns, they jumped up from a little bit over 8% to now about 24%. And that is because we've now capitalized on a growth market and smart debt, and that's jumped your 8% returns up about 16%. Again, that lets you earn roughly a 24% return on investment. So that's very powerful there. Let's take a look at where this property is. This is located in the north side of Jacksonville. This is our beloved Jacksonville right here. And you can see we've got the Atlantic Ocean over here. We've got the St. Johns River here. And all of these blue dots here are all of the properties that JWB has bought, built, or renovated and sold, and continues to do the management on for all of our clients here in Jacksonville. And so we have 4 neighborhoods that we just dominate. And one of these neighborhoods is called the North Side, which is right here. This is the West Side. This is the South Side. And this is Arlington. And as you can see all these blue dots, there's over 2,000 properties that we have bought, sold, renovated, built, and or managed. And so this is an incredible amount of data that we can use to make sure that we're setting the right rent rates, to make sure we're setting the right prices, to make sure we're estimating the right taxes. All of this is to the benefit of clients because we can create consistency for you and we can set expectations that we can then hit. So this green dot right here is 7171 Lucky Drive. And so you can just see here as I zoom in, there are literally over maybe 50 to 100 properties that are right around this half-mile radius, right around here, that we currently manage. So it's not hard for us to understand what rent rates should be for you, or how to estimate your taxes or insurance costs, or how to serve your resident so that they can stay in that home for a very long time and pay you rent and help create this wonderful asset for yourself. That's why we do it. It's not rocket science. We just dominate these areas and it's to your benefit. I wanted to talk about the reason why I see upside in this specific home here on Lucky Drive. I'm going to stop the screen share here. So on this evaluation, actually, let me show you the evaluation, and then I'll kind of explain it a little bit more here. When we're looking at the evaluations, we're always going to break down how much estimated rent we expect to get for you. On this property, it's $925. Now, this home is actually rented, and typically what you'll see is that the rent amount will match that amount that we would put on that evaluation. You would assume that makes sense. In this case, it's not the case, and it's to your benefit. So this home is actually rented right now. The resident will be moving in April, and they've signed up for a 2-year lease. They actually rented the home for $1,000 a month. That's what they're paying for this rent right now. Now, sometimes this can happen. Rents are going up in Jacksonville. And, so if we can get more rent with a resident that meets all of our qualifications, we're certainly going to do that for you. But we have enough knowledge in this area that if for whatever reason this resident doesn't work out and we go to re-rent that property, we're going to be thinking somewhere around the $925 range is where we would likely rent this home out. So what we do on our evaluations is we under promise and hope to over deliver. And so on this evaluation, you're going to see an expected rent of $925. Right now, the client who buys this property will actually receive rents of $1,000 a month. So this is an incredible opportunity. This is not normal, and that's why I feel confident telling you that there's significant rent upside. I'm generally pretty conservative on pitching the upside too much, but it's hard to avoid on this one. This is actually rented for $1,000 a month and will be to the benefit of that client that purchases it. And just to show you the difference here of what it may do for returns on investment, as I kind of branch out a little bit here and share the screen one last time. Let's see what the impact is of $1,000 in rent versus $925. Again, $1,000 is really what it's rented out for right now. That jumps your returns over just about 2 points, just about 2 percentage points. And this is exactly what it's rented for right now. So hopefully what this communicates to all of you out there is that we want to underpromise and overdeliver. We want to be conservative with our estimates. We want to prepare you for the long haul of what your actual returns on investment should be, because we care really deeply, not about just selling you one house. We want to create this asset class for you. We want to make it easy for you to invest, and we want to sell you many homes over many, many years. And we want you to tell your friends and family about us. It would be very easy for us to put the best, most rosy projections on any of these property valuations, but we don't operate that way. One of our core values is to underpromise and overdeliver. We feel like it serves everybody very well to do it that way. And this is just a great example of that. So if you're interested in this property at 7171 Lucky Drive here in Jacksonville with JWB, you can reach out to me. You can drop me a comment here on the groups and on the social platforms, or you can schedule your own time to speak with my team by going to www.chatwithjwb.com. That's chatwithjwb.com. Set up a time to speak with our sales team, and we can certainly help you out with this one. If you're already a current client, just reach out to your JWB portfolio manager. We'll get the party started for you on this one. And one other word is, many times properties sell very quickly. That's just the reality of things here in real estate in Jacksonville and in the country right now. Things sell very quickly. If for any reason this home is not available by the time you get to speak with my team, do not worry. We have many other homes that are very similar to this one. As you can see, we do the same thing over and over again. We're consistent in our approach. And the reason is because at the end of the day, we want you to love the team you're working with. We want you to love the market you're working with and which your properties are. But at the end of the day, the properties are the widgets. They are replaceable. So if you fall in love with the team, the market, the model, you're in a great spot. We'll be able to fill your portfolio with assets just like this one. So thank you all for joining us, and happy investing. Take care, everybody.